Every decade or so, a window opens. Not for everyone, just for the people paying attention. In the 1990s, it was the internet. You could have bought Amazon at $1.73 a share. In the 2000s, it was real estate, before and after the crash. In the 2010s, it was index funds and then crypto. Each time, the window opened. Each time, most people missed it. They were too busy, too skeptical, or just too late. Right now, in 2026, that window is open again. And I'm not talking about some hyped-up altcoin or a hot stock tip. I'm talking about something structural, something that's quietly rewiring how wealth is built in this country and every country on Earth. If you act in the next few years, you could be set for the next decade, maybe longer. If you don't, you'll be watching other people talk about it on YouTube in 2036, saying, "I knew about that back then." So stay with me, because what I'm about to walk you through could be the single most important financial decision you make this decade. First, I'm going to show you what this opportunity actually is and why most people are sleeping on it right now. Then I'm going to break down why the timing is so critical. After that, I'll walk you through a simple step-by-step framework for how to position yourself to take full advantage. And finally, I'll tell you the biggest mistakes people make when they try to do this, so you can avoid them completely. No fluff, no filler. Just the information you need to make a smart, informed decision. And if you're new here, this channel is dedicated to one thing: helping you build real, lasting wealth with strategies that actually work. If that sounds like something you want more of, hit subscribe right now and turn on notifications. We publish new videos every week, and you don't want to miss what's coming next. Let's get into it. Number 1, the opportunity. The opportunity is private market investing, and specifically getting access to deals that used to be locked behind a velvet rope that only the ultra-wealthy could walk through. Here's what changed. Regulatory shifts over the last few years have dramatically lowered the barriers for everyday investors to participate in private equity, private credit, and early-stage business deals. Platforms and structures that once required you to be a billionaire to access are now available to people with as little as a few $1,000s. Think about what this means. The wealthiest families in the world don't keep their money in the stock market the way you were told to. Roughly 50 to 60% of their portfolios are in private assets, real businesses, private loans, infrastructure, deals you never see on Robinhood or Fidelity. And here's the kicker. Private markets have historically outperformed public markets over long time horizons, not by a little, by a lot. So why hasn't everyone been doing this? Because for decades, you couldn't. You had to be an accredited investor, meaning you needed to already be wealthy to access the tools that make people wealthy. Classic 22 catch-22. That wall is cracking, and if you get through it early, you're positioning yourself the way wealthy families have been positioned for generations. Number 2, the timing is critical right now. Let me give you 3 reasons why this window is open right now and why it won't stay open forever. Reason number 1, interest rates are shifting. We just came through one of the most aggressive rate hiking cycles in modern history. That created something rare in private credit markets: extraordinarily high yields. Private lenders, meaning investors like you and me who fund these deals, have been earning returns in the double digits while banks tightened their lending. That window is already starting to narrow as rates come down, but right now, the opportunity is still there. Reason number 2, valuations in private equity are resetting. When interest rates went up, valuations came down, including in the private markets. This means you can buy into private businesses at prices that would have seemed impossible 3 years ago. Discounts create wealth. This is a discounted moment. Reason number 3, AI is creating a new class of private businesses. This is the one most people overlook. AI is allowing small, lean companies to do what used to require hundreds of employees. That means more viable private businesses being created right now than at almost any point in history. Early investors in these companies, before they go public, if they ever go public, stand to make life-changing returns. These 3 forces are converging. They won't all be in alignment forever. The question is, are you going to act when the conditions are right, or are you going to act after everyone else already did? Number 3, the step-by-step framework. Okay, here's how to actually do this. I'm going to break it down into 4 clear steps. Number 1, establish your foundation first. I know you came here for the exciting part, but hear me out. Before you put a single dollar into private markets, you need your basics locked in. That means an emergency fund of 3 to 6 months of expenses, no high-interest debt, and at least a basic retirement account being funded. Private market investments are illiquid, meaning you can't just sell them tomorrow if something goes wrong. If your financial foundation isn't solid, illiquidity is dangerous. Get your house in order first. Number 2, get educated on the asset classes. Private markets are not one thing. Private equity is different from private credit, which is different from real estate syndications, which is different from venture capital. Each has different risk profiles, time horizons, and return expectations. Spend 30 days genuinely learning the differences before you invest a dollar. There are legitimate books, courses, and communities dedicated to this. The investors who get hurt are the ones who rush in without understanding what they own. Number 3, start small and diversify. Once you're ready to deploy capital, don't go all in on one deal. The whole point of diversification in private markets is that you're accepting illiquidity in exchange for higher returns, but you still need to spread your risk. A good starting approach is to allocate no more than 10 to 20% of your investable assets into private markets total and spread that across at least 3 to 5 different deals or funds. Platforms like a direct syndication can be a starting point, but do your own due diligence on every single one. Number 4, think in decades, not in quarters. This is the mindset shift that separates the people who build wealth from the people who try to build wealth. Private market investing is not a get-rich-quick play. The returns come from patience. The best deals often take 5 to 7 years to mature. If you're not prepared to be patient, this isn't for you. But if you can commit capital you won't need for several years and let it compound, the outcomes can be genuinely extraordinary. Number 4, the biggest mistakes to avoid. Let me save you from the traps that catch most new investors in this space. Number 1, chasing yield without understanding risk. A 20% return sounds amazing, but if the underlying business is garbage, that 20% can turn into a 100% loss. Always understand why a deal is offering a high yield. High yield is almost always compensation for high risk. Know what risk you're actually taking. Number 2, ignoring liquidity timelines. People invest money they think they won't need, and then they need it. Private market investments often lock up your capital for years. Read the terms. Know exactly when you can get your money back and under what conditions. Number 3, going it alone without a network. The best private deals don't get advertised. They get passed between people who trust each other. Investing in your network, joining investor communities, attending real estate meetups, following people in the private equity space will pay dividends that no stock ever could. Number 4, waiting for perfect. This is the silent killer of wealth building. The person waiting for the perfect time to invest is still waiting. Markets are never perfectly priced. Opportunities are never perfectly clear. The people who build wealth are the ones who move with imperfect information and course correct along the way. So here's the bottom line. The wealth gap in this world isn't just about income, it's about access. Wealthy people have always had access to deals, structures, and strategies that regular people didn't. That gap is narrowing, but only for the people who know about it and act. You now know about it. What you do next is up to you. But if I were sitting where you're sitting right now, I would spend the next 30 days doing nothing but learning everything I could about private markets. I'd get my financial foundation airtight, and I'd start building the network and the knowledge base to make my first move. The window is open, but of course it won't be open forever. If you want to keep building on this, subscribe to this channel right now if you haven't already, and hit the bell so you don't miss a single video. We're going deep on private credit, real estate syndications, and the AI-driven businesses reshaping private equity, all in upcoming videos. And if this video gave you something valuable, drop a comment below. So tell me, what's the one thing holding you back from building real wealth right now? I read every comment, and your answer might become the next video. This is the opportunity. The only question is whether you're going to take it. I will see you in the next video.